Long seen as the oldest private equity firm in the world, Warburg Pincus is celebrating its 60th anniversary this year. And it's doing so under the stewardship of a relatively new CEO, among the youngest in the industry. We sat down with Jeffrey Perlman for his first ever U.S. TV interview since taking the top job at the firm. Perlman spoke about the staying power of Warburg Pincus, the evolution of the PE industry, and where he wants to take the firm in the future. This is Inside Alts. Well, thank you so much for taking the time, for doing this. I'm very excited. Warburg Pincus, 60th year this year. It's the oldest private equity firm in the world in this cutthroat, evolving industry. What do you think has given Warburg the staying power?
Well, it's great to be here first of all. Look, I think when you take a step back, 60 years is a pretty remarkable milestone. And I think, two things have stood out above all else. I think first, the investor-first private partnership model that we've maintained for 60 years, it's created amazing alignment, with our investors, with our portfolio companies and management teams. And obviously, we're also, the single largest investor in our own flagship fund. So alignment's an incredibly powerful thing. And I think that structure, remaining a private partnership, has, I think, been a big driver of the long-term success. And certainly Lionel Pincus and the architecture of the firm, we owe him a deep debt of gratitude for creating that single global partnership. I think the second has been our diversification by design model. I think diversification fell out of favor over the last kind of handful of years, and now I think investors are now starting to remember it as the core principle of investing that it is. But what it has allowed us to have is consistent, persistent performance over many cycles, many decades, and investors reward that.
You're only the third person to be CEO across those 6 decades. How are you thinking about making your own mark strategically?
Yeah, so fortunately I inherited a great firm. The firm's in a great position, great support from our investors. But at the same time, the industry is going to change and evolve, I think, dramatically over the next 10, 15, 20 years. We saw the first wave, which is when, and I think Lionel Pincus had a hand in it, state pension funds in the US were allowed to start to invest in the asset class. Then you had sovereign wealth funds that were able to start investing in the asset class. And now it's really wealth. And obviously retirement could be on the horizon here as well. So we're now seeing kind of this next third period for the asset class. And for us, it's an opportunity to, I think, leverage the fact that I think we have a great model also to capture the wealth audience. This global diversified model, the ability to deliver persistence over the long term. And so for us, we're really looking, as we think about the growth of the firm, how do we leverage this amazing deal engine that we've built, right? We have nearly 300 investment professionals, 64 investing partners, huge value creation team. And we had our core private equity business, but we've now started to expand into other performance-based adjacencies, capital solutions. Think about it as kind of hybrid capital, what we call partnership solutions, which is our GP-led secondaries business. As you've seen, this has now become, I think, a permanent feature of the exit market going forward. It's now about 15% of total exits. And then we've had a real estate business that's emerged from our private equity business. So we think all of these areas are performance-based products. It taps into this great deal engine that we've built over 60 years and all the relationships and the ecosystems that come with it. And I think from there, we want to continue evolving in that direction, but we're not here trying to have 35 different products. We want to do a couple things, do them really, really well. And I think investors are looking for that, and they're going to continue to reward that over the long term.
I want to follow up on what you said about wealth, because that has been an increasingly popular area. It's also one that's been met with a lot of headlines lately that may not have transpired had it been kind of relegated just to the institutional client base. Why do you see it as a net positive for Warburg Pincus? And I ask this in the construct of the redemptions that we've seen, some semi-liquid products, and how going into wealth and going into retail requires different structures, different types of communication, and potential regulatory scrutiny as well.
Look, it's a great point, a number of great points buried in that. And look, what I'd say is, you as as a firm, you always want to have a diversified set of capital flows. And so obviously we have our institutional investors, whether it's sovereign wealth funds, pension funds, insurance companies. We've always had a component of wealth who've invested with us. I think increasingly through many of their advisors, they've been really pushed more into these more evergreen, semi-liquid vehicles. And for us, of course, you want to make sure you can provide the right structure that those investors are looking for. So I do think it's going to continue to be an important feature. Certainly regulation is important. As a firm, you have institutional investors, you have to account for that. And I think in wealth, as an industry, it's important that we try and make sure we get that right. Because with retirement on the horizon, there's obviously, employers have, liability associated with that. So we want to make sure as an industry that we get that right. Because if you do, obviously the amount of capital that can continue to flow into the asset class is significant.
Do you think it's right at this point in time, or do you think there's some lessons learned that have been highlighted by the levels of redemptions and the structures that we've seen so far?
Look, I think redemptions are always going to be a function of, we have even our institutional investors also, through the secondary market, obviously trade those positions. There's obviously, at various points in time, everyone has liquidity needs. That's fair, and we always want to make sure we make that available on the institutional side. And I think you have to be prepared to do it, on the wealth side as well. So I don't think anybody should be surprised that there are going to be, redemptions, both in good times and also, in tougher periods. And sometimes that may be the place that investors look to get liquidity because, maybe the marks are tighter than maybe some of their other positions may be. So I think we have to structure the product collectively as an industry that can still consistently facilitate that. But when you also communicate to your investors as a part of that product that we will, cap the amount of redemptions, that sometimes it gets reported that that's a negative, that it's being those are folks who are following exactly as what had been communicated to those investors. You don't want to disadvantage the longer tail of folks that are still in the product by trying to accommodate that. So I do think there needs to be more education on it. But as an industry, we do have to make sure that we hold up our end of the bargain and make sure we deliver transparency and follow through with what it stipulates under the agreements.
More of a feature as opposed to a bug. You're not in private credit. Is that by design? Is that an area that you plan to stay out of, forever? Is there a reason behind not getting into it when a lot of your peers have?
It's a great question. We looked at it for our side and we said, what do we do really well as a firm? And I think, again, being performance-based with our set of investment professionals, obviously being on the equity side and now kind of on the hybrid side, we think those are more performance-based products. I think, in direct lending and private credit, that's been really more, especially if you're trying to play at scale, has been more of a beta opportunity. And it's not to say, we're big users of private credit for our private equity, portfolio. It's not to say kind of never, but at the same time for us, we want to be in areas that are, again, very performance driven. And I think that's why our investors want to continue to invest with us. And I think if you go down that path, you need a whole separate team. There's other elements. And I think what you're seeing in the industry between the listed asset managers and folks like us who are, private partnerships is again, it goes back to alignment, fee-related earnings versus, in our view, performance-related earnings. And that aligns with us also in the case of our, global flagship fund, being the largest investor in our own fund. So for us, we of course want to be, have an unwavering focus on value creation in the portfolio, as opposed to obviously looking more for scale for the benefit of AUM.
Asset gathering, as the cynics would call it.
You said it, not me.
I said in my mouth. You mentioned some of your listed peers. Is that something you would ever consider doing an IPO of your own?
It's a fair question. I always, as I've talked about it, with my partners internally, I firmly believe that right now, I think it's a competitive advantage that we are an investor-first private partnership. And if at any point in time I felt that wasn't the case, then I think like any good leader, you have to be able to take a step back and revisit that. But both with our institutional investors again, they're looking for performance-driven firms. And so I think the ability to focus on delivering the performance as opposed to maybe the scale to the point we were talking about before, and also investing talent. Investing talent wants to be in a place and a firm that prizes finding the needle in the haystack. And I think the ability for us to continue to recruit and retain, I think, some of the best investing talent in the industry is a huge advantage for us. And we want to continue to lean into that.
And speaking of IPOs, one of the biggest challenges in the private equity space these days is this distribution drought that we're seeing, lack of exits, lack of capital return to LPs. Warburg is an outlier here. Since 2020, you've distributed $54 billion across your active funds while investing $34 billion in new assets. How do you think about that relative to what the industry is going through broadly?
Yeah, it's been a little frustrating, as I take a step back from seeing it from an industry perspective, because truthfully, the industry, we shouldn't have too many excuses. The public markets have been robust over the last couple of years. If you went back to the dot-com bubble burst or the GFC, public markets were down, and private equity doesn't exist in the absence of public markets. In this case, as I said, public markets have been good, and I think what happened was really twofold that's held back the industry in terms of distributions. One is a lot of folks forgot vintage diversification. They invested way, way, way too much in the 21 vintage. This is
software and tech.
And everything. And this is, again, a very pro-cyclical industry. Investors like to invest a lot when times are really good, and then they tend to stop during periods of stress and uncertainty. And 21 was just magnified to a whole nother level at peak valuations. So a lot of firms have been waiting to try to grow into those valuations, or there was maybe some hope that rates were going to go back down to where they were post the GFC. We always like to think hope is not a strategy. And then I think too, as I'd mentioned before, investors forgot about the core principle of also being diversified. Everyone went to one single sector, single geography, single stage of investment, and then they wonder why they've kind of seen lack of distributions in the process. The benefit of being diversified by geography, by sector, by number of investments is when one door closes, others tend to open. You can always find stuff to consistently sell. I mean, that's why 9 of the past 10 years we've distributed more than we've invested. So take last year, Liberation Day happens. Obviously very tough to sell an industrials business when no one knows what tariff rates are. But guess what? Investors pivoted to more defensive areas like software at the time and healthcare. So we sold a bunch of that. This year, not surprisingly, to your point, software may be more challenging. That door may close for a period of time. But again, as investors pivot, what are they looking for? Now more industrial type businesses, more hard asset driven businesses. So if you have those, you have the ability to sell into those pockets where the doors are open. Because usually doors aren't closed across all sectors and all geographies. And I think those are the two areas where I think the industry kind of got themselves into the position that they're in. And now there is this built up inventory that we've got to continue to work through as an industry. Fortunately, to your point, we've been an outlier, and I think our investors have rewarded us for doing that.
Yeah, I know you can't talk about fundraising, but there are reports that you're on pace to exceed your goal of $17 billion. I want to ask you about the macro picture because it is so uncertain out there, whether it's the geopolitical environment or just how long we've gone without a credit cycle. How is that changing the way that you deploy capital?
Yeah, it's a really interesting question. I was just saying this we had our annual meeting recently, and I was just saying this to our investors. It used to be more about the micro than the macro. Now it's increasingly interconnected because of everything that's happening on the geopolitical front and obviously correspondingly on the macro. And because of that, you have to take a step back constantly to revisit what you're investing in, the pace of investment, and I think that's going to be here with us, for quite a while as we go forward. At the same time, you also can't do nothing, right? Because if you weren't out there putting capital to work, or in some cases selling businesses, you will have missed a pretty good investment horizon over the last few years to continue to deploy capital. So we continue to remain active, but at the same time, I think in this environment, you have to be prepared to underwrite, potential, recession in your base case underwriting. Not a severe recession, but something more a moderate recession. The public markets continued to look through all this noise, right? I think the FT recently coined yet another adjustment, right? Earnings before Iran, tariffs, and dubious announcements, right? And at some point, the public markets may reverse, but they've had tremendous outperformance, right? Public markets have outperformed their 100-year average by 50% for the last almost decade. At some point, that'll start to reverse. And on that basis, I think, again, private markets will increasingly look attractive relative to that. But, we have to continue to pick our spots.
So do you feel like the public markets may be able to look through some of the risks out there, but as a private investor, that's harder to do, and you have to underwrite to maybe not the worst case scenario, but at least to a possibility of a recession?
Yeah, look, public markets, you can sell the stock the next day. When we're making investments, we're looking out over 5, 7, even 7-year or even longer horizons than that. So I think you do have to underwrite and assume that there may be a recession over that period of time. And again, not a severe, deep recession. It's unlikely. When you're financing a 6-7% budget deficit here in the U.S., it's very stimulative, right? So it's unlikely you're going to have a deep, dark recession. But at the same time, you have to be prepared that there may be a moderate recession. Inflation had been coming down. Obviously, some of what's been happening in the Middle East weighs on the ability for inflation, I think, to stay hopefully closer to the 2%. It's probably going to get re-elevated here. And that, again, is going to create an instance where we should all expect that we're going to live in a world of structurally higher rates. And we've been saying this to our investors over the last few years. Not so high by historical standards, but certainly higher than what we lived through post the GFC. And we've continued to underwrite businesses on the basis of that cost of capital, right? Not the previous cost of capital. And that means we've lost some things that we liked in the process, but we think it's the prudent way to invest when you look out over the next handful of years.
How do you think about investing in AI as we talk about just areas that a lot of capital has gone into? Is that something that you're super bullish on? Is that an area that you feel like isn't necessarily part of the Warburg fabric and maybe going to hit at it a different way?
So we think AI is certainly going to be a transformational technology, and you're seeing it obviously very much in the early innings. Things are moving very quickly. At the same time, we're not, as investors, looking to decide which large language model is going to be the winner. But for us, it is where can we implement AI across our portfolio? And obviously, in any investment we're underwriting today, is AI going to be more of an opportunity? Is it going to be more of a threat? And in some cases, both can be true in a single company. But we did a big exercise over a year ago assessing the entire portfolio that we have, businesses that are most exposed to AI in a negative way, and other businesses that we think are going to be the biggest beneficiaries of AI because of their incumbency, because of their scale. And the reason why we did that is because AI is moving so fast, it's the one thing that we can control, right? Our own portfolio and the decisions around it. And so the ones that are a little more exposed to AI, we want to exit those businesses earlier. It may mean that we'll get a little bit less for those businesses today, but we could end up getting a lot less if we end up holding those for a few years longer. At the same time, we want to make sure we have the time and the capital to invest in the businesses we think are going to be the biggest beneficiaries of AI, because we think those will compound over the next handful of years and more than outweigh maybe getting a little bit less today for some of those other businesses.
What was the split?
Fortunately, the significant majority of the portfolio really sits in, we think, can be net beneficiaries of AI, but it's not everything, right? And you have to be eyes wide open. I laugh a little bit. If you listen to every single public company earnings calls, I have yet to hear a CEO of a public company say that AI will not be great for their business, right? It just doesn't happen. And at the same time, I think everyone has been looking at software and saying, throw the baby out with the bathwater, it's going to be bad for every business. And I think the reality is technology rarely, is 100% negative for everyone or 100% positive for everyone. And I think, we're going to have to sift through, and this is what the market is going to have to do, I think, over the next several years, sift through the winners and the losers, because inevitably there will be.
Absolutely. And lastly, I want to ask you about Asia, because you've spent a lot of time there. You have unique expertise in the region. How has investing there changed post-Liberation Day as the world deglobalizes, more onshoring in the U.S.? Have you found that investing opportunity evolved or changed in any way?
It's a really interesting area to cover because post-Liberation Day, I'd say in all my travels around the world, meeting with some of the largest investors, I think the common theme that came back was they were all revisiting what their allocation was going to be to the U.S. going forward. And
from
look,
Asia to the U.S.
No, actually, just in general, their U.S. exposure today, when you think about it, has really been a hyper exceptional level of exposure, right? U.S. is 4% of the world's population, 26% of global GDP, and it had been 70+% of global equity markets. And so I think investors looked at that and said, you know what? Instead of a hyper exceptional level exposure, it's not that they're thinking about taking it down to an average level of exposure, but more hyper exceptional down to exceptional. But what that means is there's another 5 to 7% probably of capital flows that are being reallocated. And the question is well, where is it going? Increasingly, that capital, I think, is being shifted to Asia. The reason being is investors look over the next decade, 50 to 60% of global growth is going to be in Asia. And in a world of structurally higher interest rates, you need growth. So I think that pattern is going to continue. And we think, we've been in Asia for over 30 years. And it's an area where a lot of our peers had kind of taken a step back over the last handful of years from the market, obviously with some of the issues in China. But even beyond that, they just wanted to continue to put more capital in the US. I used to joke, diversification was viewed as having 90% in the US, a couple percent in India, a little bit in Japan, and that was kind of diversification. That's not real diversification. And so I think investors are now revisiting that. Asia should be a net beneficiary of that. And we think having the footprint that we do in that market is going to be incredibly valuable over the next decade, maybe versus what it was over the previous decade.
Certainly a fascinating time. Really appreciate your perspective, Jeff. Thank you so much.
Yeah, that was great. Thank you.